So welcome back to Financial Accounting 1. Purpose of this little mini lecture is to review the in-class exercises we did yesterday on Chapter 18, which is our last chapter, and remind everyone at the risk of repeating myself, the final, which you have to get back to me by Friday, you're going to finish up, it's going to cover chapters 10, 13, and 18. So among the other ways to prepare for the exam is to go through all these exercises, both from 10, 13, and 18, because the questions on the exam are not the same, but they are similar in terms of their focus and content. So without further ado, let's go to the exercises that we did in class on last night. So Chapter 13 essentially had to do with three things. It had to do with sustainable earnings and the quality of earnings, sustainability and the quality of earnings. And we say sustainability, when we look at the income statement, we have to ask ourselves, of the amounts reported on the income statement, which of those amounts are actually sustainable, i.e. we would anticipate that the profits, the revenues and expenses and net income would look similar in future years. Oftentimes we have on the financial statements things that are for this year only and are not sustainable. And when we say quality of earnings, what we mean basically is that the person who has prepared the financial statements has been fully transparent. They're not trying to mislead the investor. So let's take a look at this first exercise here. This first exercise really has to do with the sustainable earnings. So they give us some information. They said that the following information for the year ended December 31st, 2020, and it's pretty condensed information. It's not all the information on the income statement, but it's so enough that we need to answer this question here. So they told us what sales were. They told us what discontinued operations were, that the fact that that was a loss. They tell us what selling and administrative expenses were. They tell us what cost of goods sold is, and they tell us what the loss on the sale of equipment was. And they also tell us here that the company is subject to a 30% tax. That's significant, 30% tax. So when you go to figure out the net income, you're going to have to realize the company has to pay 30%, both on its continuous income and all of those things that are not part of sustainable income, such as that discontinued operation loss. So that we had a segment of the company that is no longer there, that was operated at a loss and lost $110,000, but the actual amount of that $110,000 loss, you'd be able to deduct that loss, has to be reduced by the $30,000 tax savings. So what they want us to do is prepare an income statement, but they want us to begin with the income before income taxes. So normally when we do the income statement, we do sales minus cost of goods sold, gives us gross profit, subtract out all the operating expenses, you get operating income before income taxes, and you subtract out income taxes, and you get operating income, and then you've got to consider the other unusual items down at the bottom of the statement. So they want us to pick it up at the earnings before income taxes. So the earnings before income taxes would simply be the sales of $1,300,000 minus the cost of goods sold, minus the $160,000 worth of selling and administrative expenses, and minus the $40,000 loss on a piece of equipment, because that's part of the regular earnings. We're always going to be having gains or loss on sale of equipment. So the income before income taxes is $200,000. Then you have to subtract out the tax. So the tax is at 30% of earnings. So 30% of 200,000 gives me 60,000. So this is the income from continuing operations. So this is what we would call the sustainable income. But you had another item. You had another item on the income statement for this year that you're not going to have in future years, and that is the loss on discontinued operations of 110,000. But those unusual items, which come after income from continuous operations, need to be shown net of the allocable income tax effect. So if I had a $100,000 loss on this discontinued division here, I would be able to reduce that loss by the tax savings on that loss to 30% of 110. So that's a tax saving of 33,000. So if you subtract 33,000 from 110, after tax, the amount that we actually lost was 77,000. And I notice here there's a little error in my answer key here. That should be 140,000 minus 77,000. So net income actually is, let's put it here, So you get a complete answer here. So you end up with net income of 63,000. Right? So the learning point there is to be able to recognize which of this earnings is sustainable, and the amount that is not part of sustainable income comes after income from operations, and you have to reduce that by the, if it's a loss, you reduce it by the amount of the tax. If it's a gain, you reduce it by the amount of the tax as well. All right, next exercise. Next exercise has to do with vertical analysis. So horizontal analysis, rather. So what horizontal analysis is, we basically put 2 years side by side. We get the dollar amount of the change, and we get the percentage change. So we're given 3 years worth of data. So what we need to do is we need to see what happened in 2019. So 2019, if we're focusing on sales, we would see that sales were 2018 were 300, and this year they were 340. So in 2019, we had a $40,000 increase in sales. If we're focusing on sales in 2020, you see that sales in 2019 were 340, and in 2020 they were 355,000. So you had a $15,000 increase in sales. So they want the amount and percentage of the change from 2008 to 2019, and the amount and percentage of the change from 2019 to 2020. So what you do here, let's just focus in on 2020. I always put the most recent one actually. Oops. Always do the most recent one to the start on the left with the most recent one. So sales had been in 2019 340. Now in 2020 they're 355. So there's your increase of 15,000. So if you take 15,000 and you divide by 340, which it had been the year before, you get to 4.4. Cost of goods sold went from 202 to 214. That's an increase of 12. Take 12,000 divide by 202, you get 5.9. Gross profit had been 138. It jumped to 141. That's an increase of 3,000. Take 3,000 divide by 138, you get 2.2. As far as what happened in 2019, so you got to go all the way back to 2018. You say, what happened to sales? Well, there was a $40,000 increase in sales, because you can see it went from 300 to 340. You can see there was a $16,000 increase in cost of goods sold, because it went from 186 to 202. And you can see here there was a $24,000 increase in gross profit, because it went from 114 to 138. So there's my dollar amount. To get the percentage each year for the increase in sales, 40,000. 40,000 divided by 300 gives you 13. 16,000 divided by 186 gives you the 8.6. And 24,000 divided by 114 gives you the 21.1. So if you look at those 2 years, you could say that we had a bigger increase in 2019. Sales increased by 13%. 2020, they only increased by 4.4. And look at the difference in gross profit. In 2019, they actually went up by 21.1%. And in the year in 2020, they went up by 2.2. So that's horizontal analysis. We do the 2 years side by side. We get the dollar amount of the change. We express the dollar amount of the change as a percentage. Next one has to do with vertical analysis. So vertical analysis says that if we did the income statement, we take every item on the income statement and we express it not in dollars, but in percentages. So every item on the income statement divided by net sales. So we do that for 220, we do that for 219. This particular exercise focuses on the income statement. If we were doing the balance sheet, we would take every item on the balance sheet and divide by the total assets. So for each year, okay, we're going to take for 2020. All right, so this is, we're focusing just on year 20. Show a vertical analysis for 2020. So we don't have to do 2 years, we just have to do 2020. So for 2020, you take every item on the income statement and you divide by 360. So 360 divided by 360 gives me 100%. 210 divided by 360 gives me 58.3. 150 divided by 360 gives me 41.7. 112 divided by 360 gives me 31.1. And 38 divided by 360 gives me 10.6. So what you can say looking at that is that for the company, for every dollar of sale, they're making 10.6 cents. So the profitability of net income divided by sales is 10.6%. Right? So please note the difference. Horizontal, we do side-by-side comparisons. And in vertical, we express every item on the financial statement as a percentage. If it's the income statement, we express it as a percentage of sales. If it's the balance sheet, we express it as a percentage of assets. So the second topic in Chapter 18 was horizontal and vertical analysis. You see those illustrated here. And the third topic there is ratio analysis. So ratio analysis are very helpful in figuring out what type of story the financial statements tell. Vertical analysis, horizontal analysis are as well, but the ratio analysis is perhaps a bit more comprehensive here. So we're given the comparative balance sheet for 2 years. Be careful here. So notice here they don't have the total of all these items: cash, short-term investments, accounts receivable, inventory. Those all make up the current assets. So they didn't actually tell us what the current assets were. So you had to figure out what the current assets were. And also what they ask us in this problem, which is not in the slides to this chapter, something called the asset test ratio. The asset test ratio considers all the current assets with the exception of inventory. So notice here I didn't highlight inventory. So when we get to inventory, that's going to be included in the calculation of current asset. It's not going to be included in the context of the asset test. And then when you get to the liabilities, they didn't tell us what the current liabilities were. So you'll have to know that the current liabilities are here. Okay, accounts payable plus short-term bonds payable, that's current. And then the, in fact, I'm going to change the color there. Let's not make it yellow. Let's add a little variety to our life here. I think it's green. It's not easy being green. So there's my current liabilities. So $60,000 this year, $120,000 this year. And then also, they didn't tell us what the total stockholders' equity was. Figure out stockholders' equity. Stockholders' equity in this case is going to be common stock plus the retained earnings. So they kept this simple here. They didn't include additional paid-in capital from other sources. If you would have had that, you would have had to consider that as well. So there's the information on the balance sheet. And then here's for 2020, here's the actual income statement. So income statement, multiple steps: sales minus cost of goods sold, gross profit minus the operating expenses, income before income taxes, income tax, net income. We don't have any of the unusual items here. And then they give us some additional information. And you're going to need this additional information here. I'm running out of colors here. I'll make it pink. That's too bright a pink. You're going to need some additional information here that you're going to need when you go to calculate the ratios. Looking for a milder form of pink? I don't. It's more like purple. So this is information you're going to need in some of the ratios. The fact that they declared a dividend. When you get the dividend payout ratio, you're going to need that information. When you go to get earnings per share, you're going to have to figure out the weighted average number of shares outstanding. And what weighted average simply means, it's the number of shares, a number that represents the average number of shares outstanding during the year, because that number fluctuates during the year. And then they tell you the market value of the common stock. So when you go to get the PE ratio, you're going to need to know what the market value of the stock was. This is not the value of the stock on the financial statements. This is what investors are currently willing to pay for the stock. So the market price of the stock at the end of the year was $21 a share. So with all that information, you've got to go ahead and you've got to compute all these ratios. So this is not all the ratios. In the slide deck for this chapter, as people saw who were in class last night, there's like 3 slides in a row. I forget the numbers there. And they give you all the, on one slide, they give you all the ratios for liquidity. They give you all the ratios for solvency, and they give you all the ratios for profitability. What I would suggest you do for purposes of this exercise and purposes of your take-home exam, actually print those out, and you can refer to those, and you'll find your formulas in terms of how to compute those. Right? The challenging thing here is I'm not asking you to memorize the formula. The challenging thing is to be able to go to the financial statements, which you see here, and extract the data that you need to complete the ratios. Now, I'm not going to keep going back and forth between this page and the next page. So please take note now. The yellow here is your total current assets. So for 2020, it's 2020 plus 40. That's 140 is your current assets. Did I get that right? Yeah, 140. And your current liabilities are 60. and your common stock here is 260 at the end of this year and 220 at the end of this year. Also, be mindful of the fact that this is the amount of dividends they paid, this was the number of shares outstanding, and this is the market price of the stock. I highlight that information because I know I'm going to need it later on. So let's get to the current ratio. So the current ratio is simply the current assets divided by the current liabilities. Where did I get the 140? Go back and look at the previous page where you see the comparative balance sheet. Where did I get the current liabilities? Again, go to the balance sheet on page 4, and you'll see those were the current liabilities. So I've got a current ratio of 2.3, which means for every dollar of current liabilities I have, I've got $2.3 worth of current assets. Then you want the return on stockholders' equity. So the return on stockholders' equity would be the net income divided by the average stockholders' equity. So between common stock and preferred stock at the end of the current year, it's 260. At the end of the previous year, it was 220. You get an average between those two. I think that's 240. And you divide that into 63,000 and you get 0.263. So you can say that as a percentage, they are earning 26.3% return on investment, which is actually a pretty good rate of return in most cases. Right? So that means for every dollar invested in stockholders' equity, they get more than 26 cents worth of profit. Then they want the price earnings multiple. Price earnings multiple, go down here. To get the price earnings multiple, what you have to do is you have to take the market price of the stock and you've got to divide that by the earnings per share. Now, I know what the market price of the stock is. I don't know what the earnings per share was. I have to calculate it. So earnings per share is net income, which you got here. And they told us the weighted average number of shares outstanding was 30,000. So 63 divided by 30 gives you 210. Take the market price of the stock, divide by the earnings price per share. So we say that this company is selling at a multiple of 10. So the stock is selling for 10 times the earnings per share. Acid test ratio is like the current ratio, but you take all the current assets with the exception of inventory. That's why it's 80,000 as opposed to when you did all the current assets, it was 140. We don't include the inventory. So the acid test is all the current assets, not including inventory, divided by current liability, and you get an acid test ratio of 1.3. Okay, so the acid test ratio shows the company less liquid than the current ratio because the acid test ratio doesn't include inventory in the numerator. Now you want accounts receivable turnover. So the accounts receivable turnover would be the accounts receivable on the balance sheet, which is 400,000. And divide that by the average accounts receivable. So accounts receivable at the end of this year, accounts receivable at the end of the previous years. So they collect their receivables 11.4 times each year. Okay, so that's a measure of how good a job. The higher that number is, the better job we're doing collecting our accounts receivable. Times interest earned, this is the cushion that we build up to show that we've got sufficient earnings to cover our interest payments. And the way you get times interest earned is it is the net income off the income statement for the current year, most recent year. You're going to add to that the income taxes, which were 27,000. And you're going to add to that the interest expense, which was 18,000. So take those and divide by the interest expense. And what that tells the reader of the financial statements is that I have a cushion to cover my earning. I'm actually earning 6 times the amount that I pay in interest. So this is a measure of how much comfort or how much of a cushion I have to pay my interest on my debt. So the higher the number is, the more on a long-term basis, the more solvent the company is. Profit margin is simply the net income right off the income statement. Net income is 63,000. Divide that by the total sales of 400,000. That's where I got the 0.158 or 15.8%. To get the days in inventory, what you have to do is, first of all, you have to get inventory turnover. So inventory turnover would be the inventory of 250 right off the balance sheet. I'm sorry, that we get the cost of goods sold right off the income statement, 250,000. And then you got to divide that by the average inventory. So cost of goods sold divided by average inventory. So I've got an inventory turnover of 3.8. So that means on average, I buy and sell my inventory almost 4 times a year. To get the days in inventory, you take the 365 and you divide by the inventory turnover. So that tells us on average, we've got 96.1 days worth of inventory in stock. Is that good or bad? Again, when any of these ratios, you got to compare it to what it was in previous years. You got to compare it to your competitors. You got to compare it to the industry. Payout ratio very simply takes the net income of the company, which was 23,000. I'm sorry, the dividends rather, 23,000, and divide by the net income, which was 63. So what that tells the reader of the financial statements is for every dollar we have in net income, we pay out 0.365 or 36.5% is our payout. So 36% of the net income is paid to the stockholders. The rest is reinvested in the company. And then the return on assets would be the net income right off the income statement, divide by the average stockholders' equity. So stockholders' equity end of this year, stockholders' equity at the end of the previous year, divided by 2. So it's 14. All right. So those aren't all the ratios. I think this is about roughly half the ratios. Ratios might be a little bit different than what on the final, but the approach is the same. You're going to get a bunch of numbers, going to get a comparative balance sheet, you're going to get an income statement, you're going to get some additional information. Then you're going to be asked to compute a number of ratios. So the challenge is, if you've got the formulas for the ratio, you need to be able to go to the financial statements and abstract the right information. Okay, so I hope you found that review useful, and go through the lecture on Chapter 18 exercises. I could see on my YouTube account, quite a few of you have done the Chapter 13 exercises, reviewed that video. I haven't seen anyone look at the Chapter 10, so you might want to go back and definitely look at that one as well, because the exam covers all the last 3 chapters. All right, so good luck, everybody. I look forward to receiving your exams. Remember to email those to me per the instructions. So Mr. Spock and I wish you all well, and good luck on your final. Bye-bye.